Guys, welcome back to We Talk Money, episode 168. Man, I can't believe we've been going for that long. That's pretty awesome. But let's talk about the markets, because it seems like everybody is like kind of in freak out mode, or at least like anticipating a bubble. Nikki, I know you've been off like hanging out in Vegas at the Sphere with the Backstreet Boys, and Trav's just been playing pickleball, and I've been riding my bike. But yeah, we actually have been pretty dialed in. But yeah, I don't know what's going on out there. Is the world collapsing?
I mean, the Sphere was full house. Everybody was there watching the Backstreet Boys. I didn't see a seat not taken, and the tickets weren't cheap. So I don't know.
But you know what's funny about that? I've actually been seeing a lot of YouTube videos on my feed popping up, and the theme is Vegas is dead. And it's people walking around showing how quiet it is outside of the Sphere. Was that your experience? Or
So during the weekday, because I got there Wednesday and I was there Wednesday, so I saw Wednesday, I saw Thursday. Things were dead Wednesday and Thursday. I was actually quite surprised. Friday, it picked up. I mean, the Bellagio in front of the fountain, you couldn't walk through it very easily. So, of course, I hadn't been to Vegas in many years, so I'm trying to remember what it was like, a decade ago or whenever the last time I was there. But it was definitely feeling slower during the weekdays, but the weekend picked up, and from what I could see.
yeah, a lot of the videos are also just complaining about the price gouging and like, resort fees and how expensive, drinks and food are now, and people showing receipts and just complaining how Vegas is, I guess, out of reach for like the typical vacationer now. So I don't know, how are Vegas stocks doing lately?
I don't know how Vegas stocks were doing, but I do know that I paid a lot of money to eat. I paid $29 for avocado toast in the morning. I paid $57, of course, plus tax tag title, for a buffet, a breakfast buffet. It was amazing. It was incredible. Um, Feels expensive, $60 for a breakfast buffet for one person.
I don't know. TD, look at this, man. Caesar's stock is down pretty damn big from all-time highs. It's down like 80% from all-time highs. What's going on out there?
Yeah, I mean, MGM and Caesar stock don't look super great. The flip side to that, though, is Wynn and Las Vegas Sands, which have some non-US exposure in casino as well, about 50-50 non-US. Those stocks are actually near multi-year highs. So you could kind of cherry pick your data point that you want there and make a narrative out of it, which is, basically the world we live in these days. It's just crafting narratives, apparently. But
Yeah.
the reality is it's probably like still doing really well at the high end, and then in the middle and lower tiers there's definitely some slippage because Vegas took too much price. And it's not that dissimilar from what we saw like in restaurants. We were talking I think on the last show or the show before about how some of the restaurant stocks have been hit, and we've been seeing like Chipotle had its second negative comparable store sales decline, and that's a pretty unusual for Chipotle. Prior to that, it had been like, I think, positive comparable store sales in every quarter since like 2016. So some of these restaurants that use COVID as an excuse to rapidly raise prices to high levels are now feeling the heat from that and feeling the blowback. And I think consumers are pushing back in areas where, maybe they aren't feeling like they're getting value. So I think that's a general trend, and certainly hitting Vegas hard in some areas. But, at the high end, it's like asset prices are still up. The wealthy definitely feel as wealthy as ever. So, at that level, I don't think you're feeling too much pain.
Well, so this is the big narrative, I think, that we've seen over the past week or two is, people talking about the PS ratio on stocks being near all-time highs, saying, hey, this is basically late 90s again, or, the last bubble, the last AI bubble that we had a few years ago. And, a lot of people talking about the AI boom and potential bubble. And Trav, I know you're working on a video on your channel for that. So yeah, what do you guys make of like just like sky high valuations? Like, are we near unsustainable levels? Are we in a new paradigm? Is this time different? Are we looking at a future crash? Because, the price action has really just been kind of steady, like really, really tight kind of boring trend throughout the summer. And Trav, I know in our Discord you were basically showing how the VIX had the fastest collapse ever, where we had super volatile spring, and then we went into this just really low volatile summer. So is this the calm before the storm, or is this trend going to just keep on trucking?
Yeah, that's the $1 trillion question, right? Yeah, I mean, I think from a valuation perspective, I don't feel like we're in a euphoric bubble of, unseen proportions at this stage. I mean, yes, overall valuations are at a pretty high level relative to history, but we also have like the highest corporate margins in aggregate, particularly for like the S&P 500. And so, things like the price to sales ratio aren't great at capturing the fact that, the companies at the top of the S&P 500, have incredible operating margins and cash flow generation. And it's basically the best businesses that have ever been at the top of the weightings of the S&P 500. So certainly there's a component there. But yeah, I mean, we're at like 21 or 22 times earnings on the S&P 500. It's not, I think we peaked out at somewhere around like 25 or 30 times forward, and it was a little higher, maybe 35, 40 times on a trailing basis in the S&P at the very peak of the .com bubble. So could we go higher? Absolutely. I mean, especially with the level of fiscal spending and money printing we have, like it would not shock me to see the S&P 500 trade at 30 times earnings on a forward basis. So we could absolutely go higher here, especially if we get more into a speculative bubble. So it does feel like things are, yeah, a little bit bubbly, but not at a level that's like, the red sirens are flashing yet. So I am doing a video soon on my channel. Actually, I've been doing a ton of work on it right now about whether or not, AI is a bubble that's about to burst and what the implications are for stocks. So I've got a lot of really good data on that I'll be sharing in the video on Stock Geek TV soon. So look out for that.
That'll be really important, because Nvidia is basically the stock market now, right? So whatever Nvidia does, the market's going to follow. And I feel like, Bitcoin will probably follow that too. So crypto investors should also pay attention to the AI bubble.
Yeah, all those Mag 7 stocks have a massive impact on the overall market. We're seeing that in Google today. Google may be rescuing the S&P 500 and the NASDAQ from a correction here, just off of a 7 or 8% move. The judge ruled in their antitrust case that they don't have to sell Chrome, that Google also doesn't have to stop paying Apple for its search placement. So those are pretty significant catalysts for Google. And literally, it looked like yesterday, maybe the NASDAQ and the S&P are rolling over. And then of course, Google's positive news kind of saved the day, at least in the short run. Right. So yeah, the Mag 7 have never been more important to the S&P 500 and the overall market. Passive indexing, we've never seen this amount of passive investing into the same stocks over and over. And the amount of ETFs now apparently is larger than the number of individual stocks in the US market. Right. So there's all these things that definitely make us a little nervous. But it doesn't mean that the end is here. It's calling a top, becoming a bear, and saying that, it's gotta crash from here has never really been a great strategy for investors.
I have a fun fact on this topic. S&P 500 Q2 earnings growth for the Mag 7, 26.6% versus the bottom 493 at 8.1%. So
wow,
this tells me two things. One, wow, still really good. Two, the Mag 7 is just outsized earnings growth versus the bottom 493. And I think that's why we're seeing these higher PE, higher price of sales. Investors are fine paying it because these companies are putting out the growth and the margins.
I will
right?
say, and this, yeah, and I mean, I will say, and this is to preview just one small data point that I was pulling up for the video that I'm making. A lot of people think that the other 493 stocks in the S&P 500 aren't growing earnings at all, but actually about 3/4 of them do have positive earnings growth this year and are expected to grow earnings next year. And the average or the median earnings growth rate for the non-Mag 7 stocks in the S&P 500 this year will be about 7 to 8%. Assuming we don't have like a crash in the economy before the end of the year. So, that's still pretty good. It's not like the 15 to 25% earnings growth that we're seeing in some of the Mag 7 stocks, or even in Nvidia's case, growing earnings at, whatever, 50% plus, but 7 to 10% growth rate for a basket of companies in the S&P 500 isn't terrible. So yeah, it's not like all the other companies are doing terribly. And so I think sometimes that gets obscured too. Although, like Nikki said, the Mag 7 is still very, very, very important. And if those start to roll over and there are some issues with earnings next year because of all the money they're spending on AI, that could create some pressure at some point. It's just, I think I'm not ready to call the top just yet.
Yeah. And what do you guys think of small cap? Like taking a look here at the Russell, I think we talked about this last show, how, my thesis was like, if this breaks out and like, if the Russell, 2000 small companies are able to break out to new all-time highs, what does that mean for everything else? Right. And especially crypto. Like, I think this would mean like just risk on for so many different things, but obviously there's no guarantee this has to break out, but damn, it sure looks like it wants to.
Yeah, we've seen some interesting signs of rotation into small caps in the last couple of weeks. It's like I feel like the market's still trying to figure out if it wants to actually, do the full on rotation or not. If it really wants to push, capital into the small caps and the Russell versus the large caps. But there's definitely been some signs, like certain days, where we're seeing that rotation. And the argument would be, of course, too, if we get the rate cut in September, that should be beneficial for small caps, and that a rate cutting environment generally should favor small caps. And if large caps, are at high valuations, maybe there's value in small caps, right? So there's a lot of arguments and a lot of signals that could point to a small cap rotation. It's just like if you look at the NASDAQ versus the Russell, or the NASDAQ versus some small cap index over the last 5 years, there's been like a few like little small blip downs where it looked like the Russell would start outperforming, but then you zoom out and the overall chart is just up and to the right in terms of NASDAQ versus Russell. So it's like, again, another trend that, do you really want to call the end to the large cap dominance? It will happen at some point. It's just like, do you want to get run over trying to make that call early? That's tough.
Yep.
Not with this earnings growth. I don't know. It's tough.
Yeah.
Not with this earnings growth.
And that's why I'm like, okay, if Bitcoin is following large cap stocks, the NQ, this is kind of the chart that I pull up every day, is I'll compare Bitcoin to the ES and then also the NQ. And I'll just ask, like, all right, what if this does just keep grinding higher? Like, does the Bitcoin 4-year market cycle end, or does it keep expanding? And my thesis is that if the AI bubble doesn't pop right away and large cap or the Mag 7 or 8 or whatever keeps growing at these insane rates, does Bitcoin keep going with it? And do we actually exceed up here in the 170K range or more? Do we exceed the value of all public stocks, not together, but each individual stock, right? Like, does Bitcoin become worth more than Nvidia, Amazon, etc.? I think that's still a possibility. We hit the first profit target, but I'm still just looking to stocks to kind of guide the way. And also, when we've got gold that this week and last week broke out to a new all-time high, we've also got silver. So some of these, hard money assets are still doing really, really well. And, right now you've got Peter Schiff doing the victory lap, obviously, after, very poor performance for the prior decade. Over the last year or two, gold has actually been doing extremely well. But I think if gold does well, Bitcoin also does well. So it's like, okay, large cap does well, Bitcoin does well, gold does well. Like everything looks just kind of rosy. So I'm like, all right, well, where's the black swan? Where's the counter argument to that, right? Where's the counter trend trade? What are the things that we should be looking at that could get in the way of that happening?
And it makes it really hard from a portfolio construction standpoint because, gold's supposed to play a little bit of a hedge role against some of the other risk assets in the portfolio. Bitcoin has it from time to time also done that. But when they're all just going up together, it's like, well, if we get a shock to the economy or the markets at some point and they all go down together, then, you're not really getting any portfolio benefit from being in multiple asset classes. So yeah, it's a real conundrum. Like, man, I struggle with it sometimes, like thinking about, do I put on hedges like when I start feeling nervous or when I start feeling people getting more euphoric? Like I have at times, but then it seems like most of the time it's just like I'm just burning capital on those put premiums or hedges. And so It's tough. It's tough. You don't want to fight the trend, but at the same time, you do want to be thinking about what the strategies are if things do take a quick turn.
Yeah. Let's talk more about the macro and like what things could cause a turn. I know we've been looking at the employment situation, and there's been a lot of talk, I guess, about the bifurcation between the wealthy and the poor. I'll pull up some stuff that you guys shared with me. Nick, what was this one about the McDonald's CEO giving a reality check on the economy?
Yeah, I mean, people are kind of seeing this as a dark cloud. How, first of all, McDonald's raised their prices a lot, and they had to backpedal because the demand was slowing, and they finally, were back to trying to do value on their menu. But the CEO is basically saying, "Hey, high income, doing great, doing fine. Lower income, we're seeing demand slow." Um, and my immediate thought to that is, when have we not I guess kind of had the haves and have nots, the income and the low income conundrum, right? Of course, different types of economic conditions make this worse or make this better. Like during COVID, we actually saw low income people um do better. They were able to spend more, they were able to save more, their balance sheets got better. So, of course, every single recession and economic change is going to bring a different type of economy. Um, and so I guess I'm starting to think, in what world do we not kind of have that bifurcation, so to speak? Is it just more, is it getting more extreme because the wealth is getting, more extreme? People are getting super wealthy. And what changes it? So from here, where do we go? Lower rates maybe help low income individuals a bit more. But I don't know. I don't know if you guys have any thoughts on kind of what is going to change this bifurcation that we're seeing. Has it always been there, just more extreme at times than other times, so to speak? Because overall, the economy seems okay overall when we look at the big picture.
What about the jobs market, though? I mean, we've seen some deterioration, right? Like job openings are much less, and labor participation rate not awesome. I don't know, what have you guys seen there?
Yeah, and
This
then
is
we had
huge. Yeah.
the big revisions too last month to the official unemployment data, which actually made it look like there were way fewer jobs added than had previously been reported. And I don't know if that was exactly why Trump fired one of the people in the labor department, but that was a whole thing too. But yeah, I mean the jobs data does not look super robust. My worry that I said on the last show, that I keep thinking about is, if we do get a recession, is AI actually going to make it worse in this next recession because companies are going to use AI to try to do the job of people that they fire? And then, could that create a slowness to rehire people again coming out of a recession? So I think that is a possibility that I've been thinking about, is like, when we do get the next recession, there will be another recession. There always are. Cycles always happen. Is it going to be exacerbated by AI and companies trying to cut headcount? And that could be a real problem if we have that happening kind of in mass from companies. And so that's where I do get a little bit worried. And I mean, nothing looks like it's rolling over rapidly in the jobs data. And actually, because of the slightly weaker jobs data, it does make it more likely now we get rate cuts. And so that could help ease some pressure in certain areas of the economy that are rate sensitive. So it's sort of like one variable moves, the other variable adjusts, and and then we just stay on the path that we're on for now until something wrecks it.
Yeah. And talking about the whole like income disparity and, what happens if AI crushes the job market. Something else that has been a kind of a hot topic, at least over the last couple of weeks, is the whole like capitalist versus anti-cap people. That over the past couple of days, Patrick Bet David kind of went viral for doing a Jubilee interview where it was him versus, I think, 20 anti-capitalist people. And if you watch the clips, I mean, it's pretty clear that the anti-cap people just got absolutely destroyed. Like, their worldview is quite silly, in my opinion. Nikki, I know you even pulled up some stuff on the personal finance side, some people that were recently coming out as anti-capitalist, but they work in personal finance. Like, what are you seeing over there, and what are some of the points that they're trying to make being pro anti-cap?
Well, first of all, this theme is coming up a lot, I think, because people are tired of the bifurcation between, again, the haves and have-nots, right? So people are starting to want to push back against the system and be anti-capitalism. There was a woman who's popular in the personal finance space who's basically admitting, like, yeah, I was a capitalist and now I'm since I've been in the personal finance space, I'm an anti-capitalist now. And some of her points were power is being held, across a small number of people, which leads to quote unquote fascism and just super, major control with a small percentage of the population. And then arguments that the middle between like the middle class and the capital class, which I can kind of push back on some of that a little bit because a lot of corporations are actually giving middle class workers capital, they're get or equity, sorry, in their company, right? So a lot of people have actually come out of poverty by working and being, in that uh, working class, and they've been given equity through RSUs or other types of equity-based compensation, and they've become very, very wealthy. I, as a financial planner, I know many of these people that didn't have a lot and now they're very rich. So I don't know. I think some of these arguments I think are flawed. I believe that the consumer holds more control than people think. We are the ones choosing where our money goes and what we want to buy. So I guess I can argue that maybe it's the consumer that's really kind of pulling the strings. And you can see corporations have to backpedal, have to change, have to adjust based off of what the consumer is choosing to do. So we have a lot of power, I think, as consumers.
Trev, what do you think of the whole debate? I've just been kind of laughing sitting back watching it because to me, it just seems like a lot of victim mentality and a lot of like conspiracy theory thinking where the anti-cap people are like, oh, all the power is controlled by a select few people and there's no opportunity for the small person to rise up. And like Nikki said, I mean, we've seen so many examples of how that's not true. Like in the real world, people that started with nothing and, now they're multimillionaires because of capitalism. I don't know. Where do you stand on this whole debate?
I'll start with that famous quote that I'll probably butcher, which is like, I think it's a Milton Friedman quote. It's like, capitalism is the worst economic system except for all the others. And so it's like, there's this idealism that a lot of younger people have about, what would life be like, if we could be more socialist or more communist or whatever, or, not have this capitalist system, have some utopia. And it's like, okay, well, you look at all the other countries, even, I mean, you could argue, hey, China has kind of successfully implemented communism at some level. At least they have like really nice infrastructure and now they've got like these technology industries. But guess what? The wealth is still concentrated among the Politburo class and like the people who run the country. And there's one guy who is not really democratically elected. And, the same could be said for certain countries in like South America. You look places like Russia, right? I mean, you look at all these other countries where other systems are in place and it's not like, there aren't a small group of people who are very powerful and very wealthy. In fact, probably more so in those countries, right? You look at the failed experiments in communism and socialism in the past, and also that's how it plays out. You have like, not just like economic hardships, but you also have like atrocities committed, right? Without any system to like replace those people, and so I do think, our capitalist system, there's a lot of things you could say that are wrong with it, especially in certain industries where it's not even really a capitalist industry. Like look at healthcare, like what even is that? Or what is, certain parts of, like the economy that's, controlled by the government or dictated by the government. Right. And so there's like a lot of things where it's like, you could have these academic arguments all day long, but when you look at like the prosperity that has happened over time, and really the biggest thing that I try to focus on is there still economic mobility? And in the US, I still think that's true. Nick, you mentioned that, there are a lot of employees who get very valuable stock grants, RSUs. There's also people that own real estate that have gone up in value over time. And so, there are a lot of people who live in that middle class and upper middle class who have had the ability to live great lifestyles, have prosperity, and then, also like upward mobility for a lot of people. I'm an example of that. And so the university system, things like that. So I think there's a lot of valid criticisms of the system, but I also think that when you look at the totality and the evidence and the history, it would be hard to come away with the idea that any of the other systems are vastly better than what we have. And I still think we need to make improvements, but it's like, okay, go live in a communist country or a socialist country for a while. Tell me how that is in terms of prosperity, because it doesn't seem to be any better. In fact, it seems a lot worse in a lot of ways. That's my opinion.
Here, man. Great points. And yeah, I mean, like you said, I think the three of us are examples of upward mobility, right? We weren't born in destitute, but we also weren't born into money. We created what we have by our own efforts. And I think most of our friends and colleagues and extended circles are in a similar situation where we surround ourselves with people that have desire to do better in their own lives and provide for their families. And like, I just think the capitalist system offers that in a way that no other system ever has. And so if you're willing to work hard and put in the effort and take risks, like, you can do really well. And some people don't want to do that. And some people just want to bitch and complain and have the government, supply everything for them. And I don't know, that just seems like a kind of a victim mentality and just not very exciting.
And it's crazy, isn't it? Like today, like with the internet and the amount of like entrepreneurship and the amount of content online that you can learn from, even without going to like a 4-year school or having formal education, it's like the opportunities are so boundless in today's world. It's like, yeah, if you're focused on complaining about it, like, why aren't you focused on, trying to do something about it and trying to create things and trying to create value and then have some of that value accrue to you. So it's like, yeah, I don't know. It just seems crazy in a world like we have today with so much opportunity that you would want to like go backwards to some system where, some small group of people gets to make the decision for billions of other people. I don't know. It just sounds crazy to me. But
yeah. And one thing that I took away from the Patrick Bet-David debate with the 20 anti-cap people was just they didn't want to take responsibility for anything, and they wanted to complain about everything, right? It was like, no, I can't succeed because of XYZ. And they didn't realize PBD was an immigrant from Iran who started with absolutely nothing. And so that went against their own worldview. And so, yeah, I just hate the victim mentality. And I think if more people just embraced like what you said, like, hey, there is so much potential and so many pathways to build wealth today that excuses just don't work anymore. I don't care where you're from or the color of your skin or your gender or any of that shit. Like, there is just endless opportunity right now if you're willing to work for it. All right. You guys want to do some Q&A?
Let's do it. Got some good questions.
Yeah, I know. We reached out over the past week and we had a bunch. We'll get to as many as we can here, but let me go ahead and pull some of these up. While we're doing that, while I'm pulling this over, John was asking, are you guys thinking about the medium to long-term investments in the AI sector? I know the topic of AI is hot right now, but are there any infrastructure opportunities that you see out there? I thought that was a pretty good one, especially Trav. I know you've been really diving into the AI stuff recently.
Yeah, and I think the first wave of AI investing in the public markets has been directed more towards infrastructure layer. And so I actually think that may be where some of the issues, some of the what you might term like bubble investments are in terms of valuations, but also the total amount of capital like going into data centers right now, And so it's like, if you look at any stock that is directly correlated to data center revenues, things like cooling systems or power systems for data centers, or certainly like the NVIDIAs of the world, the chip makers, all their stocks are up several 100% over the last 2-3 years. And I think there could be still more to come in some of those, but you're starting to get to a point where you are seeing a lot of heavy spending. And I think there's going to have to be a digestion period for that at some point. Is it 2026, 2027? I don't know. So I do think if you do get a correction in this huge AI spend bubble, it will probably happen in that infrastructure layer. And that's where you have to be careful. So I'm not sure that I would be focused particularly on the infrastructure layer from this point forward. And so I actually think what could be more interesting is as we move into the applications of AI and those become more powerful. And so the software layers, the application layers of AI, we don't have that many public companies that I think are perfect pure plays on that right now. But I think we'll get more coming to market here in the next 1 to 2 years. And I think we will see certain companies. I mean, we just saw the earnings reports out of Snowflake and MongoDB, for example, both stocks up more than 20% after earnings reports because they are seeing accelerating adoption of their database solutions. So I do think I'm going to start focusing a lot more time and research on the application and software side of AI, where I think the next wave could really come. And then I think maybe the third wave is going to be some of the more futuristic areas like AVs and robotics, which we're already seeing some signs of people getting excited about that. But I think that becomes a pretty big investment theme, later in the decade. So I would say, yeah, I'm really focused on trying to find some opportunities in the application layers and maybe later on in robotics, as opposed to the infrastructure layers where all the institutional investors, all the retail investors already know the stocks. They've already bid them up a lot. And if there is going to be an area that pops, that will probably be one of the first areas.
Man, great stuff. Listening to some of the robotics bulls that are out there, you would have thought that we would have had like full-on Jeeves robots in our homes by now, but that's probably going to take a little more time than we expect, huh?
Yeah, it's a tough problem, especially if you're working on like humanoid robots and like they have so many degrees of freedom and so many things that they're trying to do and be more general purpose. We do have a lot of like industrial automation and robotics already in play. That's I think probably will actually have a lot more application explosion here in the next like couple of years and a lot more adoption. So yeah, humanoids, I mean, it looks like they're making pretty fast progress. Tesla, Figure AI. There's actually another private one that I invested in, but the, again, commercialization is still, I think, a little ways away, and mass adoption is definitely a ways away.
Cool. All right, Nick, I've got one for you. Potentially, I don't know if you can answer this or not, but can you critique this asset class allocation strategy? Long-term investors who dollar cost average weekly, basically age like 35 to 40, tax advantage accounts are excluded and fully funded. So we've got a little bit of an allocation strategy, and maybe this is a good time for your disclaimer. Wait, you are muted.
Oops.
There we go.
Yeah, I'm a financial advisor, but not your financial advisor. So all of this is just informational and general, not personalized. So, but generally speaking, I did look at this and I see no bonds. It's 100%, kind of risk assets, equities, crypto, things like that. So that's always something to keep in mind is making sure that having a portfolio that's only risk assets, that fits your risk tolerance. This person said 35 to 40, pretty young enough, right, to be full blazing into risk assets. But at some point, you're probably going to want to be thinking about that a little closer. I'll just kind of point out some of the things. The cryptocurrency allocation, 10%. That is that's going to be so different for everybody. Like my clients, a lot of them have allocations 30% or higher, but the general rule of thumb for most people who don't like to take a lot of risk with huge, volatility, 10% is going to be like the max for them. So people that aren't full-blown crypto investors that just they've been in it a long time and they're okay with those higher allocations, you're probably looking at like a 5 to 10% crypto allocation. So that actually falls in line, but some people might need more, of course.
Some people might need a lot more.
Right. And this is exactly why I say that. So that's a big one, but I like it. I like that international is only 10%. I think it's hard right now to allocate too much to international versus the US. Like we discussed earlier, the US is still, we have the best companies. They're still growing at very high, healthy rates, it's kind of hard to bet against the US stock market right now. So I think having international exposure is great and people should have it. But at the same time, I think it's hard to bet against the US. So I like having, more going towards domestic or
I
US equities.
I did notice one thing in here, Nick, which is I think they're more overexposed to the Mag 7, Mag 8 than they think. Mainly because they've got a 35% allocation to U.S. index funds, which we know is pretty top heavy with Mag 7. But then you look at something like the dividend exposure, 15% exposure to dividend stocks. But like you look at JEPI, which is the largest ETF there in that category, and of the top 10 holdings, several of them are Mag 7 stocks. And so I think you might, and then you've got another 20% bucket in what they're calling global blue chip firms. And again, that is heavily dominated by Mag 7. So they potentially could have, rather than it looking like maybe initially they've only got 30 or 40%, they might have upwards of like 50, 60% exposure to Mag 7 heavy ETFs.
This is a huge problem I
sneaky.
see.
Yeah.
Huge problem. A lot of people are not as diversified as they think when they're, building their ETF portfolios. There's always room for improvement. I don't think I've seen a DIY portfolio that I couldn't improve. But overlap is a huge issue that a lot of investors just aren't aware of. And that's why in the community we're teaching, like, you want to really research these ETFs and make sure you understand your allocation and again, not being overexposed to certain areas.
Good stuff.
Yep. I know we have a lot of questions, so you can move on from there.
Yeah. I think that was valuable for people. Yeah. Just to think about obviously crypto allocation and then like overlap. I know, Nick, that's something you've talked about before, is people build a portfolio and they don't realize that they're actually more concentrated than they think. All right. Tim was asking, Bitcoin September dump is basically tradition at this point, but Powell's likely to cut rates. What other short-term macro indicators are you looking at that could potentially change this narrative? Yeah, so I agree. I mean, the fall is typically a point where we see both crypto and stocks that have had bear markets in the past. I don't just look at one thing, right? Like I look at like the whole pie. I look at technicals. I look at correlating factors, like what's the stock market doing and how is that impacting Bitcoin's price. I look at on-chain factors. I look at now, the ETF flows and things like that. Even derivatives, futures, options, like what's happening in those markets. And then from that, I'm able to get the whole pie or the whole pizza, right? Just to understand. So if I don't think for me, there's any major like macro indicators that I'm focused on. We talk a lot about the employment situation and things like that. Those are more like slow moving. And I think for me, I look at technicals first. So like, just for an example, like looking at, I don't have the chart up, but looking at Bitcoin's chart, we had 4 green months in a row, and then August was red. And then the question now is, do we consolidate in this upper range of between 110 and 120, or do we have a deeper pullback? So for me, it's more about just looking at all these things. But guys, I guess specific to this question, are there any other macro indicators that you think could potentially impact Bitcoin specifically?
I mean, I think, it's certainly subject to any of the major macro factors out there that affect other assets like stocks. Like, so anything in the currency or interest rate markets, bond markets in particular, can have like big effects in the short run. I mean, I think longer term, the drivers are, basically asset class adoption, fiat debasement, right? Like the things that we've talked about over and over, like those don't change. And so like, in the short run, I guess it depends on how much you're trading in and how much it matters. I mean, like even things like the yen, right? Like the yen carry trade could affect it, like in a short-term time frame, like we had like in the summer of 2024. You might have a quick correction because all of a sudden there's a freak out in, yen versus dollar or whatever. But most of those things like tend to be pretty fleeting. I do think like it's also funny because like gold, like you had this relationship in the past between gold and real interest rates. And then that relationship totally broke in the last 2 years. So like you can have relationships, macro relationships you think work. But the reality is like the world is complex. There's a lot of variables. And so it's like, it's hard to give you like a prescription for like, if this, then that, like if this happens with rates, like Powell cuts, then Bitcoin goes up. Like it's just not that simple. That's why we, Chris, I think you kind of hit the nail on the head, is like, what is price action telling you? What are on-chain fundamentals telling you? Like you kind of got to triangulate a bunch of different variables to like kind of get a sense of where things are headed. And we do the same thing on the stock side. We look at earnings, fundamentals, we look at price action, we look at, valuations, we look at all this stuff, and you kind of create like a holistic mosaic or a holistic picture of it to try to figure out. But the reality is like no one has a perfect forecast record. I mean,
yeah, we've seen a lot of those relationships that we thought were going to go, historically not over the past few years, 5 years, give or take. So it's just been, I don't know. We'll see at this point, because it's been so crazy and things just haven't gone as to plan.
Macro is hard. Macro is a pain in the ass to try to forecast, man. That's why I'm like, my motto is price action is truth, and all these variables. It's like, you just don't know how the macro variables are going to impact price action a lot of times. So
yeah, and it's like, I think the longer term macro variables, those are a lot easier. Like we were talking about in 2017, how institutional adoption for Bitcoin could be a huge long-term driver, but it still didn't stop Bitcoin from going through a couple of vicious cycles from, then till now, right? So I do like, though, thinking about those longer term factors just to give you that anchor. It's like, okay, that allows you, when dips do happen, like you're like, okay, like nothing has changed on a long-term macro fundamental basis. Like the US government is not going to stop printing money. There's only 21 million of, finite supply of Bitcoin, right? These things like can create your longer term bull case, I guess. And that's always what you can anchor around when you do have corrections.
Yeah. All right, next question. Wasi Boy was asking, what is the yen's role in the global markets, and why so often do we see articles about what the Bank of Japan does? That's actually a good question, because like even here in the States, we hear like, oh, the Japan trade unwinding, right? We've had a couple of those narratives over the past couple of years that have kind of impacted price, and then people in the West are probably like, why the hell do we care about the yen? So I guess specifically, like what is the yen's role in markets, and like I guess just in general, like what are some of the things that people could think about when it comes to the forex basket of fiat shit currencies, I call it.
Fiat shit coins. Yeah, I mean, Japan's important for a couple of reasons. Like one, it's like, I think it's like, the third largest economy in the world. So, it has an impact on other economies. The yen specifically is often used as a funding currency for carry trades. And so a lot of like macro funds, institutional investors will borrow in yen and invest in, assets outside the country. And actually the Japanese themselves are known for doing that. Even some Japanese retail investors will often borrow in yen to invest in, say, US tech stocks. And so that's why, like, when that unwinds, if you have the yen making a big move in a short period of time, all of a sudden people get nervous, or people get margin called on their yen borrowings, and then they have to sell other assets. So that becomes kind of like it's essentially like a leveraged trade. So that's why sometimes, at least in the short run, it can have a big impact on other assets. And that's why people watch it. That's why people watch the yen relative to the dollar, or the yen relative to the euro, because a fast move in that currency pair can create ripple effects in other asset classes. And then, also Japan, it's a wealthy country, like I said, third largest economy in the world, and they had a huge like property bubble back in the 80s and early 90s that busted, and so that had ramifications. That's less of a concern now, but certainly like the Japanese economy again can affect like other economies and can have like ripple effects. And right now there is kind of a weird thing happening, which is the Japanese long-term bond yields are rising a lot. They're hitting like multi-year highs, and that could become a concern. That we haven't seen that spill over in a dramatic way yet to the currency, but other than for like a very short time frames. But that could become a problem if the Japanese bond yields become really unanchored and start to really get parabolic. Then again, you could have a situation where there's risk off. You have selling of global assets, global risk assets, just people panicking, and then that gives an opportunity potentially at some point for a viable dip, but could create a lot of pain in the short run for people who are over leveraged.
Great stuff. Next question. A boat was asking, how would you hedge your portfolio in 2026? Let's see, motorcycles, airstreams, guns and bullets, maybe some like rare Japanese whiskeys. I don't know. What do you guys think?
What a crazy thought to not. What if we're just gonna see the market continue higher? I mean, like, what a thought to just maybe if we get really overbought, hedge with taking profit and getting cash. But I feel like people have really been burning a lot of capital trying to bet against this market. And
Yeah.
2026 earnings growth is still expected to be pretty robust. Of course, all of this can change. The black swans, the job losses, unemployment rising. I get it. But what about not and just riding this out?
Well, we talked about in the spring the pain trade being to the upside, and that's exactly what's happened. Like, what if the pain trade is it just keeps grinding higher? And again, we don't want to sound like perma bulls because we're certainly not, and we are always on the watch for risk. And but like Trav said earlier, he's burned some money trying to hedge. And like, for me, the one thing that I do is I outsource my hedging to managed futures funds, which have historically done well for me. They're underperforming this year. I can't remember. I don't even know if I'm up or down net on those funds. But in 2022, when the market was down, 20% plus in the stock market, my managed futures funds were up 60%. And so it's like, yeah, I don't know. You can either overthink it and try really hard, or you can just let the trend be your friend and then, take some profit along the way. That's what I've certainly done in Bitcoin. But
I just think some people have been overly aggressive with trying to bet against this market and hedge the risk, and it just hasn't been working. And at some point it will work, I'm sure, but timing it has been very, very difficult. Even timing the 20%, correction that we just saw this year. I don't know. I just feel like the trend, the technicals really let the technicals guide you, like you've said over and over again. And if things start to roll over, sure, make some adjustments, put on some hedges if that's going to make you sleep better at night. But I also think at the same time, people have wasted a lot of money trying to do this over the past few years.
And I think like how I'm thinking about it personally, like I've been thinking about that question, like, is there a way for me to like quote unquote hedge without getting like outright bearish? And Nick, you mentioned taking profits. I think also paying attention to your exposures. Like if you find yourself, 80% exposed to 5 stocks and they're all highly correlated, then you may need to do something about that. You may need to find some other uncorrelated stuff. Maybe you add a little bit more value stock exposure than you otherwise might, right? Maybe you reduce some of the high growth tech stuff in favor of some value allocations. Like that's one way to actually stay allocated to the market, but just a different segment of the market. Because I do worry, I said earlier, like I kind of worry that you have like even assets like gold, which would traditionally be a partial hedge in the portfolio, is acting like a risk asset alongside stocks and crypto right now. So yeah, what do you do if you're not going to get outright bearish? There's not a lot of uncorrelated assets out there right now. I think you have to find sectors maybe that are a little bit more out of favor or showing value. Be wary of your own like portfolio's concentrations and be willing to like adapt quickly if like the conditions do change going into 2026.
I think to that point, not enough people think about hedging through adjusting allocations. It's always, I got to put on, options. I got to put on futures contracts. Or I got to, short via those methods. It's not usually, let me pull some cash out of my most profitable, biggest gainers. Let me shift my asset allocation to where I'm still exposed, just like you mentioned, Trav. However, not as exposed to Mag 7 or as exposed to equities. Maybe I move more into bonds and dividend stocks, value.
International,
not enough,
yeah.
International. Again, metals, and maybe Bitcoin does act as some kind of hedge depending on what monetary policy looks like going forward. But not enough people think about hedging through allocation. And I think that's a big one.
Well, and I think we said earlier how it's tough to hedge when everything's kind of going up together. It's like, what are the uncorrelated assets? And I just want Bitcoin to be inversely correlated to stocks so bad, but it's like just keeps climbing with it.
Maybe it's more so about the lower volatility, like hedging via you're still exposed, but less volatility than what you would normally get with your current allocation. So it's not, everything's correlated. You're not going to get it perfect, but you can at least reduce volatility.
And when the cycle turns, there's some real turds out there right now trading for large market caps that we'll be willing to take bets against. Like companies with no revenue that have like $15 billion market caps. I'm eyeing a few of those, and I'm licking my chops. When the time does come, there will be shorting opportunities or downside capture opportunities and some stuff. Very similar to like 2022.
Yeah, I like that idea. Go into those individual names that are super bloated and just shorting those.
Yep.
Versus the S&P.
All right. Talking about cycles, Allegra was asking, what do you guys think of the Bitcoin/crypto 4-year cycle? Why did it repeat last time? And why will it not repeat this cycle? Yeah. So good question. I know we've talked about this quite a bit. I'll just pull up the larger time frame. If you look at a yearly chart of Bitcoin, you can see that since its inception, it's basically had this price pattern where it goes up. It goes up for 3 years in a row, and then it has a red year. So 3 years up, 1 year down, 3 years up, 1 year down. And then right now, we are currently on the third green year. So the expectation is that 2026 is going to be a red year. Now, the question, and this is what I think about every day, is it still a self-fulfilling prophecy, meaning that so many people believe that it's true that it actually just plays out that way? Or at some point, does it become a crowded trade, meaning everybody's in agreement and then something changes and then everybody's caught off guard? And because it is a crowded trade, something weird happens and it fails to do that. Now, an example of that is like last market cycle, everybody had the laser eyes on social media and crypto Twitter, and everybody was like, laser eyes means we're going to 100K. Everybody had the same damn profit target, and then it didn't get there because it was a crowded trade. So that's an example of a crowded trade. The 4-year market cycle is more so driven by the halving cycle, right? The new supply of Bitcoin gets cut in half every 4 years. So that does help that cycle in price also kind of mirror the 4-year halving cycle, but that doesn't guarantee that we have to have 3 up years and then 1 down year. The demand side still has to be there. And the more correlated we become with stocks and the more derivatives there are and the more market participants there are, the harder it becomes for that self-fulfilling prophecy to play out, I think. And so I'm thinking about what stocks do more than ever. You know, the earlier market cycles, Bitcoin didn't really give a shit. It was trading to its own accord. Now, so we're just seeing so much correlation that's why I'm more dialed in on the stock side and the macro side. And as a Bitcoin or a crypto person, if you're ignoring that stuff, you're choosing to ignore a lot of really important data. So that's kind of my thesis is, I don't know. It's either going to be a self-fulfilling prophecy, or there's going to be some kind of decoupling that we see that supply crunch where we have institutional buying that just goes nuts, or we have government buying that goes nuts, and say there is a bear market in the stock market, but Bitcoin just goes to 1 million because of the supply crunch. So I think there was actually a correlating question with that I wanted to just kind of tack on for the sake of time, because I know we're going short on time here, but Section was asking, could the continuous buying of Bitcoin by big institutional money be a strategy to eventually just buy up all the supply so people will be locked out forever, right? So like basically, like, could there be a supply crunch where the institutions just buy up all the Bitcoin? I think that is the extreme bull case, right? Is like, what happens if we've already seen the supply of Bitcoin on exchanges going down for many years in a row. What if, like, one day you try to buy on Coinbase and it's like, hey, sorry, like right now the order book is so one-sided where there's all these buy orders and there's no supply on the ask side of the book, that's where that God candle scenario comes in, and we go from a 110K to 500,000 in a few days. Now, again, I'm not saying that's necessarily a good thing. If you're counting your chips, yeah. But like a supply crunch like that is possible. Is it guaranteed? No, because the higher price goes, inherently more potential sellers, because people would want to take profit, right? Like, think about that. If you have a bunch of Bitcoin that you bought at 100 grand and at 5x to 500,000, would you want to take some off the table? That answer is greater than zero, right? So the supply demand dynamic is always going to be there. But yeah, because of the finite situation and distribution of Bitcoins, like that is the risk, I guess, is that institutions just eat it all up. And that's my my TED talk.
Here, here. Well said.
All good points. I mean, yeah, you're right.
Yeah, I mean, I don't know what else there is to say about that. Let's go back to the Fed. Freeman was asking, if the Fed cuts interest rates in September and continue to cut throughout the year, are we going to see stagflation and then like stay above 2% inflation? Yeah, what do you guys think of that?
I mean, yeah, maybe I've just got like Fed fatigue, but I feel like the market is just a little too overly focused on the Fed cutting rate at this point. Like, I think we'll get the baby 25 basis point cut at the September meeting. I mean, the market's basically saying that now with its probabilities. But it doesn't necessarily mean that we're all of a sudden now back at a rate cutting cycle where they're cutting at every meeting. And so I think, like, I don't know, I might be overblown. Like, people that are losing their minds, oh, the Fed's cutting rates now, and like, oh, inflation's going to reignite. It's like, if they cut from like 4.5 to 4.2, or from 4.2 to 4.0, it's like, I don't think it's going to move the needle that much. And the 10-year yield kind of does its own thing. It'll figure out where it wants to go, independent of what the Fed is doing on the short-term rate side as well. So like, we don't even know exactly what that even looks like. Is that going to actually like help the housing market or not? It may not. So there's like, to me, I think I don't know. Again, I think it might be a little bit overblown, the worry from people who are worried about like a Fed rate cut cycle reigniting inflation at this point. Honestly, again, I think like the bigger risk in my mind is like employment rolling over and you getting the stag part of that stagflation, where you get just a really weak labor market. And so I kind of do want to see the Fed maybe be a little bit more aggressive, maybe get rates down to like 3.5 on the short term. And I'm not convinced that that's going to create like this reinflation, like massive wave. The tariff stuff is creating some worries about inflation as well, and that might actually create some shorter term upward price pressures as well. But I think that would be relatively short lived. So I do think the market may freak out at some point about stagflation, but I think maybe it's a little bit overblown in terms of like the Fed causing another inflation upwave. And so I think, honestly, from my viewpoint, the greater risk is the stag part of the stagflation. And that's why I'm watching the employment data so closely, and why I mentioned earlier, hey, I am worried about AI making like a potential unemployment situation worse. And so that, I think, is to me, the bigger risk is like you having the economy just like rapidly cool down or rapidly go into recession. That'd be the thing that I'm more worried about in the next, like, call it like 1 to 2 years.
Trav, I have a question. Do you think lower rates in turn kind of improving the housing market, job gains from the housing market moving again, do you think that could help offset some of the job losses from AI? Like, is the housing market that big and that important that if rates go down, maybe some job gains from that, right?
Yeah, it is. I'm just not convinced that like the Fed cutting, even if they cut like, even if they do like 50 to 100 basis points in the next year, I don't know like if it's actually going to help that unlock the housing market that much. Like, it'll definitely help a little bit. We've seen like volumes rise when we get under like 6% mortgage rates, but man, I don't know. Like, I just haven't seen evidence yet that like that the 10-year isn't going down. And so the spread between the 10 year is really what matters for mortgage rates. And so even if the Fed cuts, if the 10-year is not going down, it's not really going to help us, right? But I do think your point about the housing market, it does have an impact on overall jobs. It does have an impact on the overall economy because of its size. And so even the wealth effect from home prices can have a big effect. So I do think I don't think we can ignore the housing market at all. I just right now I'm just like the link between what the Fed is doing in the housing market is a lot looser than we thought because the 10-year yield is being stubborn. So like yeah, that's kind of my take right now.
I did see a tweet. It was a projection of where housing, where mortgage rates are going to be in the next 12 to 24 months, and it's not budging much according to these projections. I'll have to pull up the source, but yeah, that's the big question mark right now is, will the 10-year budge anyway? And I was doing some math, and I think we need to see like 150 to 200 basis points lower in the mortgage rate for it to really make a big impact on affordability, and we have a ways to go to get there. So
Yeah, I agree with that. I mean, any kind of, quarter point or even half a point move in mortgage rates isn't going to really affect prices. But yeah, let's say, we get, a 1 to 1.5%. That is very, very meaningful. And could that reignite another housing bubble?
that's the big argument right now. There are actually people saying that we're crazy for wanting rate cuts because it's going to increase housing prices. So that's a big one that I'm seeing circulating.
All right. Last question. I know we've gone over an hour here. So, Trav, this one's for you. How do you manage your legacy portfolio versus the public 100K portfolio that you started on your YouTube channel last year, or other portfolios that you have? Do you make similar changes between them all, or is there a point where you become more hands off? So basically, yeah, like, are you making the same moves in the public portfolio and your other portfolios, or do you have portfolios that you manage differently?
That's a good question. I mean, so the legacy portfolios did have positions, or do still have positions that I didn't add to the new portfolio, and so I've been slowly selling some of those positions in the legacy portfolios, and so I do have to think about like positions that are in those portfolios that I don't have in my 100K portfolio. But when I add a new position, I'm typically adding it to most of the portfolios that I manage for our family. So yeah, if I'm working on a new idea, I have a lot of conviction in, if I've added it to the 100K portfolio, then most likely I've also added it to like most of the other family portfolios. I will say, however, that I do manage some portfolios a little differently. Like my kids' portfolios, they're on a lot longer time horizon. But I'm also like, in some ways, I'm like, I manage it a little differently. Like I don't take options positions. Like I don't want to screw theirs up, even though they have like the tolerance for a lot of risk because they're young. I also don't want to, like, I want to make sure the compounding machine works for their portfolios. So I take like pretty much stock only positions. I do occasionally do some ETF stuff and just like set it and forget it. I'm not as like actively short-term managing their stuff. And so like what I do in their portfolios will be a little different than what I do in, say my portfolio or things like that. So there are some capital bucket differences as well. It's hard to like, without giving you all my financial information, tell you exactly how I do it. But, every day I sit down in the morning and I look over all the positions and I think about like, am I adding anything? Do I need to take profit on anything? Some of that's dictated by what's happening in the market. And then, I probably a little less frequently will make changes in some of the like the kids' portfolios or the family portfolios where it's like the capital buckets and risk levels are a little different. So, yeah, it's an active process.
Do you have any like just completely passive portfolios with just ETFs, or like are you pretty much actively managing everything? Or
I actively manage most of it, but there are some like small areas where it's like. And some of that is because like I literally can't pick single stocks in a couple of the accounts. So it's like I have to, by law, like in an education account, for instance, it has to be in mutual funds or ETFs. And so basically I can't even do a whole lot in those accounts. But it's maybe better that way in some sense. So
government's like hands off.
Yeah.
I'm waiting for the 529s to allow IBIT.
That's right. Yeah.
I don't know if any do yet. I have to find out, but man,
some of those things are kind of a racket, right? I mean, like luckily the fees aren't like crazy like some of the corporate plans are, where you find these like corporate 401ks that get tied in with these companies, and then they're like mandatory paying like 4% loads on these crappy mutual funds. You're like, what the hell? Who made this decision, right? Luckily the 529
somebody got paid out the back door.
Yeah, right. Exactly. Like someone was enjoying a nice steak dinner and got wooed into it. But
Yep.
uh, but yeah, like the 529s are still like relatively restricted, and it's annoying. But
Yeah. I like kind of having the different capital buckets where, you have your active stuff, you have your passive stuff. I know we've done a lot of that, and it's good. It's like, man, there was a movie clip. I forget the name of the movie. I always forget, but it was where he was talking about like your FU money, like every guy knows, like you start with $2.5 million, you put it in, treasury bills, you live off the interest, and then from there, that's your fortress of solitude. Above that, then you can do whatever you want. You're operating from a place of power, right? Like you start with that passive stuff and you're going to be able to eat. And then from there, you can just take big risks with anything extra. So that's
it's
why I think
very
we like
similar
to.
to our escape velocity portfolio concept in a lot of ways.
Yeah. Yeah. For anybody that doesn't know that, escape velocity is when your portfolio gains outgrow your dream lifestyle burn. So let's say your dream lifestyle within reason, like obviously lifestyle creep can come in, but let's say you burn 300K a year living your perfect average day every day, and your portfolio gains are $301,000 a year. Congratulations, you've hit escape velocity, where even living your dream lifestyle without having to work or add more capital, you're going to continue to get wealthier over time. And there are different levers that you can pull on that, right? Gains, risk, volatility, contributions, things like that to get to that point. And in the wealth building community, if you go to wealthincubator.com and look at our community, you'll see that is the main goal of like what we're trying to help people do, is get to that point where you have that ultimate freedom. Some people are more fire, they want to go lean fire, where they're, saving and investing lower amounts of money and they don't need escape velocity and they're going to draw down over time. And that's okay too. Everybody's got different goals. But I think if you want to have the best definition of what true financial freedom is, that's escape velocity. And a lot of people, they don't know how to, let alone define it. Let alone even have a path for how to get there. So that's what our community is about. That's why we do all this content for you guys, and why we're not just out riding our motorcycles right now.
You trying to tell us something?
You are muted.
Oh,
We lost him.
we lost him. I don't think I was muted.
There we go. I think I got kicked off. I don't know why my video isn't working anymore, but can you guys hear me okay?
Yeah, we can hear
We
you.
can hear you. We can't see you.
Okay. Well, we'll go ahead and wrap it up there, guys. Anything else y'all want people to know before we ride off into the sunset?
No.
No, we're going into fall, y'all. It's so exciting.
Yeah.
I told my wife she can't have a PSL until the temperature drops below 90.
Below 90.
90 Fahrenheit, yeah.
Fair.
Yeah, that seems fair, right?
Fine.
No, I'm kidding. Well, I did tell her that, but she's already defied that, so that's
Yeah,
okay. I'll let that one go.
Don't blame her one bit. But it's freezing in Colorado. I'm like bundled up. I'm so cold.
Jealous, man, jealous. We'll get there.
Yeah, but in like December, January.
That's right. Yeah.
All right, guys. Well, I cannot hear anything, so I'm going to go ahead and wrap it up. But,
Okay.
You guys have a great one, and yeah, we'll see you next time.
See ya. Bye.